Okay, right. So part two, let's carry on. So our focus here is we were just talking about dismantling costs. So let's carry on. So like I think I highlighted this already, that the discount on this liability would be unwound. That's the technical term. The unwinding of the discount over the period until the dismantling costs are paid. And I did that sort of double entry there where you debit your investment with the deferred liability. And then every year you literally put through a finance cost and credit the deferred liability. And when you now come to pay, you debit the deferred liability with all its interest costs and you credit back. So again, it says this means the liability increases by the interest rate each year, with the increase taken to the finance cost in the statement of profit or loss. And typically you will be given an interest rate, and you will apply that to the number of years. So again, we did this when we talked about consideration with goodwill, where you were intending to pay you're intending to pay cash in 3 years, and I sort of explained again how it works. Really, we're really asking the question: what is the present value of a figure here today? That's all we're doing. So it doesn't really matter how many years you're given. The key point is, again, I'll start with this. I'll start here. I'll call this Y. So if you have Y, and imagine it's 10%, I'm just again pretending. It doesn't really matter what percent it is. It could be anything. So if I have Y here today, just to sort of prove this, if I have 100 here and I have 10% on that, that's 100. That's 10. That's 10 pounds, isn't it? So I should have 110 pounds in the bank by the end of year one, and then I have another 10% on this. I think that's by 11. And so what you now have here is you should now have 121 or something. So really, you would agree, right, that really what I'm saying is I'm saying 100 times 1.1, which is 110, and then I have 100 times 1.1 times 1.1. So I'm kind of really just multiplying everything by 1 point whatever the percentage is, and then I have 100 again times 1.1 times 1.1 times 1.1. Now imagine I was just doing 3 years, right? I get here. So that means that if I take Y, which is this 100, so I'm just going to call this Y now. So Y times 1.1 times 1.1 times 1.1 is equal to whatever it is I have here at the end, right? Z. But if I know Z and I'm trying to find Y, I could just say, well, that means that if Y times 1.1 raised to the power of 3 is equal to Z, well, that means if I'm looking for Y, that means that, and I know Z, that means that Y is equal to Z over 1.1 raised to the power of 3. I mean, yes. But this is the same thing as saying Z times 1 over 1.1 raised to the power of 3. So sometimes in an exam, they'll give you this thing already calculated. You can test it yourself, or you literally have to do this kind of go back yourself and sort of put in. So all you're literally doing is in your calculator, you won't be able to you won't be comfortable with being able to just take any number or whatever, 1.05 or 1.08, and raise it in your calculator to the power of the number of years prior to paying. So let's look at this example here. Again, like I say, I am literally using the text. It's my preference. If an oil rig was built in the sea, the cost to be capitalized is likely to be included, again, like I say, in the cost of constructing the asset and the present value of dismantling it. If the asset cost 10 million to construct and would cost 4 million to remove in 20 years, so that's my issue here. How do I capitalize that 4 million? And the present value of this dismantling cost must be calculated. If interest rates were 5%, the present value of dismantling calculated as follows. So that's the 4 million, and that's me discounting that 4 million to present day. So I literally said 4 divided by 1.05 raised to the power of 20, right? Which is the same thing, of course, as saying 4 times 1 over 105 raised to the power of 20. So just put that in your calculator, and you get this 1 million. Yes, 1.5, roughly 1.5 million. So I will capitalize the full cost as we have to construct, but I will also include this initial dismantling cost and depreciate. You can see that's what they're doing there, depreciate each year. But then I would also increase the liability again, which is literally 5% of this 5%. Where are we? 5% of this figure here, year on year. And this increase is taken to the finance costs. Right. Okay, great stuff. This next question again is important, because no one is denying you that sometimes you make mistakes, or sometimes there are issues with costs that you're spending. I mean, you've spent it, but the question here is about the integrity of our financial statements, or giving a faithful representation of what is the asset, if you like, of what costs have gone. What is the actual cost of building the asset? You see, because an asset should really contain the cost of what it is, as opposed to you just spending and making mistakes and having all those costs in there. No. And they must pertain to the asset. So first of all, general overheads are not unique to the asset. These are general. So these costs should not be capitalized. They should be revenue, sort of expensed. That's the first thing. So once you have general overhead, but all these relate directly to the non-current asset in question. So let's look at the first problem here. The following information is also relevant. Material costs were greater than anticipated. On investigation, it was found that materials costing 10 million had been spoiled. Well, you've spent, yes, I accept that you've bought material, debit 10 million, credit bank, but that 10 million was not used for the actual building of this asset. It's not in there. Again, like I say, I apologize. I'm sorry. So you would have to expense it. So as a normal material expense, whatever, call it what you like, 10 million, credit bank. But you cannot include it in. So I need to deduct 10 million here. That's the first thing. You cannot. And it says, and a further 15 million was incurred as a result of faulty design work. Well, no, that's not directly related. It's not in there. It's faulty. In the normal course of work, it would cost you X. You've made some errors and you have an extra 15. So therefore, that can't be considered as part of the actual normal costs. The normal costs, if that's the term I'm looking for, because these are abnormal, and we do not recognize abnormal costs. So there you are. So those can't be there as well. And then finally, it says the work on the building ceased for a fortnight, and it's estimated that you still had to pay 9 million in labor costs. I accept that, but that can't be capitalized. You put it through as an expense, so you can still hit your, reduce your profits by it, but you cannot capitalize this 9 million that you, whatever, call it furlough, if you like, or just not recognizing that cost. So your labor costs cannot include the 9 million over that time. And so this is really a structure that we're building for our own use, if you like. So what am I saying? So we have 583. I'm just going to sort of 583 here. I'm going to take off, yes, the 30,000. That's not allowed. I'm going to take off 10 million. I'm going to take off the 15 million, and I'm going to take off the 9 million. And let's see what that brings us to. That brings us to 583 minus 30,000 minus 10,000 minus 15,000 minus 9,000. It's 519,000 is what I can, is what I can work with. And that, if you like, is what we will capitalize as a tangible non-current asset. Brilliant, good. I think, yes. Oh, yeah. Oh, I had a working slide. I had 2 working slides that I didn't use. Okay, good. So what we'll do is, that'll be the end of part 2, and we'll carry on with subsequent expenditures.